The immediate implications are going to be a period of uncertainty and likely risk aversion. For many months now, international organizations like the IMF and several policymakers from around the world have warned of the risks of an outcome like this. Those risks have now been realized, and I think it's fair to say that some markets were perhaps partially prepared for this, but other markets were certainly not, and risk premia were quite low. So we would expect to see a period of continued risk reduction. The longer term implications and what this vote highlights are the ongoing risks of political developments for financial markets. And of course, the Brexit vote isn't the only political development that's going to occur both this year and next year. This year, obviously, in October, we have a referendum in Italy about political reform. We have the US elections, of course. And then next year, and this is going to be obviously going to be a big focus following the Brexit vote, we have elections in France and Germany where there are nationalist, populist movements that are polling quite well. And actually, of course, before that, goodness, we have the Spanish elections this weekend. So, I think the political risk premia that impacts on financial markets is going to rise, and it's going to stay high for quite some time. So of all the markets that were preparing for Brexit, in the currency market was the area where we saw perhaps the most preparation in terms of investors trying to protect themselves against potential sterling weakness. However, it's likely the currency market's been one of the most liquid ways to express views that sterling will continue to bear the brunt of the immediate fallout from Brexit. And one of the things that we would be concerned about is that we would estimate that fair value for sterling against the US dollar is at around 147. And so yes, it's overshot a little bit already, but it could overshoot a significant amount more from here. Well, it's curious because in the preparation for the Brexit vote, we noted that international investors actually had continued to increase their holdings of UK equities. Now, that might in part reflect that investors were still somewhat underweight UK equities. However, the fact that they didn't reduce risk significantly and continued to buy UK equities ahead of the vote is interesting. And I think one of the things that we're concerned about in the aftermath of the Brexit vote and the uncertainty that will surround it is whether we see those international investors begin to reduce their holdings of UK equities, which obviously could lead to some pressure on the UK market. One potential offset, though, of course, is the fact that sterling weakening could be a supporting factor for UK equities, which might limit the potential risks in the equity space. So, in theory, gilts should be a safe haven amidst the economic uncertainty that follows the Brexit vote. There are, however, a couple of areas of concern in the fixed income space, and I think the first is on inflation. So it seems highly likely that sterling weakness will lead through into a pass-through into much higher inflation. And in fact, some of our online measures of inflation are already suggesting, even before the vote, that the annual UK inflation rate was above 1%, which is already above the Bank of England's year-end forecast. And I think in part, inflation markets in the UK, certainly inflation-linked bond markets in the UK, aren't ready for a pickup in inflation, and so there's one risk there. And of course, then the other risk, similar to equities, is this question of what foreign investors do with their gilt holdings. So, in a similar vein to equities, we noted that investors had actually been increasing their holdings of gilts ahead of the vote. There'd been no sense of trying to reduce their holdings in preparation or to hedge themselves against this Brexit risk. So that's the other angle that we're looking at as to whether foreign investors will continue to buy gilts after the Brexit vote.